Good morning, everyone, and welcome back to our monthly market update series with today's webinar. Before we call in our guests, a preface for today's session. We are living in uncertain times. At the time of our last webinar, US tariffs seemed like they would disrupt trade flows. Then the world responded by imposition of reciprocal tariffs. The tug of war on tariffs is far from over. The sudden flare up of the India Pakistan war and the quick resolution of the conflict merely added to the erratic behavior of the market. From October to February, FIIs were selling. It seemed like they won't come back for a very long time. But in less than a few months, they are back buying Indian equities. All in all, we are less than 5% off from the peak of Nifty 50 in September 2024. It cannot be a more opportune time to discuss asset allocation choices. On that note, it's a real privilege to welcome one of India's most seasoned and respected investment minds, Mr. Sankaran Naren, CIO and ED at ICICI Prudential AMC. With over 3 decades of experience across asset management, Naren is renowned for his data-backed discipline, sharp macro understanding, and perhaps even a deep contrarian approach at times. He has successfully navigated several of India's most volatile market phases, always with a long-term valuation-driven lens. Along with Naren, we have Vaibhav Porwal. Most of our regular audience is now familiar with Vaibhav. Vaibhav is the co-founder and head of investments at Dezerv. Vaibhav's perspectives combine market intelligence with a deep understanding of investor behavior, making him a trusted voice for both seasoned as well as first-generation investors. First of all, Naren, thank you so much for coming on the show. Thank you for taking the time to speak with our audience here.
My pleasure.
Sir, let me start with a very top of mind question. Despite global tensions, we've seen trade tariffs, we've seen military escalations. Indian markets, though, have had a very sharp rebound. We've risen, 15% since March? What, in your view, are the key drivers behind this rally? And of course, how sustainable is this rally?
I think there are two key drivers. One is the global driver. The global driver comes out of the fact that dollar is an asset class which is not in favor. And if you look even at the overnight news, Moody's has downgraded US debt to down from AAA. You have a situation where the US has a serious fiscal and current account deficit problem. And that problem means that people need non-US asset classes at this point of time, which means that they need to invest in things other than dollars. And therefore, they're searching for asset classes other than dollars. So they've been investing in gold, they've been investing in other things, and they've been investing in various asset classes, which includes China, which includes Europe, which includes everything other than US. So that has actually forced a lot of money into India as well. So that is one driver. The second driver is that domestic inflow into equity, whether it is through EPFO, whether it is through NPS, whether it is through SIP, I think whether it is through the mutual fund channel, I think except direct equity, which had seen some setback, particularly in the Jan to March quarter, we have not seen any drop in inflow into equity from any other channel except the direct equity channel. And therefore, that amount of money keeps coming. And you had a situation where there was a slowdown in IPOs, QIPs from the corporate sector, and even blocks from the private equity and other people. So you had a very, very buoyant flow situation, FI money plus local money and very little supply of local paper. So you had it had nothing to do with earnings. It had valuations have expanded. If you look at if you look at earnings has been average. If you look at the March quarter, people can celebrate earnings, but most of the earnings have come from sectors like oil marketing companies, partly from banks. These are the two sectors which have drastically surprised. Other than that, I would say nothing has really surprised, but it is flow which is responsible for this big boom at this point in time.
Fair. So, clear from your point, Naren, you're suggesting that liquidity and flows coming in from US largely has driven the market. Webo, are you seeing this differently? Any other reasons for this rally over the last few months?
Most of what Naren sir said is perfect and responsible to a large extent for this rally. Besides that, I think there were a couple of technical factors also. Given the amount of volatility which was there in the market, the short build-up in the index future was also very high. And some short covering, which means people who were negative on the market, were forced to unwind their position. That also created a positive momentum for the market. So if you look at March and early April index future short data, that was indicative of the fact that people were bearish on the market. Along with that, if you look at the kind of stocks which have gone up, all high beta stocks have gone up, which is suggestive of the fact that people were bearish on the market and suddenly they were forced to unwind their position. And as Naren sir said, liquidity has been immense and there has been no supply of paper. If you look at second half of last calendar year, the number of IPOs which were hitting the markets were very high, and a lot of liquidity which was coming in the system was getting absorbed by these IPOs, which has not been the case for last 60 days. So these were the two factors in my mind which contributed additionally to this up move, which is much higher than what any of us anticipated.
Great. Moving on, next question for you, Naren sir. Beyond obviously this short-term rally, how do you see the global macroeconomic scenario and specifically India currently? What should investors look for in terms of macro factors for the next 6 to 12 months?
You can remove the sir and call me Naren, please. And in my opinion, the India macro is in fantastic shape. So you have a situation where fiscal deficit, current account deficit, inflation, growth all seem okay. And what has improved significantly in the last 6 months is domestic liquidity infused by RBI. The banking system liquidity used to be almost in deficit. From there, by the end of May, after Reserve Bank dividend, the banking system liquidity is going to be at a record surplus of maybe 5 to 6 lakh crores. So, on top of the good macro, you have a situation where banking system liquidity is going to be so high that banks will be forced to find some avenues to actually give money. Otherwise, they are going to be sitting on an ocean of liquidity from a situation where they used to be suffering for looking for deposits. So that is the big positive. So what is the problem in the Indian economy is there is a section of society which is leveraged and who have taken personal loans who are not able to repay the personal loans. There's a section of society which has taken microfinance loans which have not managed to repay the loans. That problem is not solved itself, and I would say that problem remains. And so there is a set of society which is not able to increase their incomes to repay the loans. So that is a problem that exists. But otherwise, if you look at that is a micro problem, I would call it. But macro is absolutely fantastic. On the other hand, you have US where everything that can go wrong is going wrong because for 20 years we knew that US was having an increased fiscal, increased current account, and the world didn't bother saying it's the reserve currency of the world. But after April 2nd tariff, everyone now knows that US has a bad macro. And top of it now, Moody's downgrades India. So you have a situation where all the macro problems of US is showing up. I would say US is the other end and India is one end at this point of time from a macro point of view. Micro problems are notwithstanding. I would certainly say micro is a problem in India. We need more number of people to afford cars. We need to have a situation where the total addressable market of everything has to go up. Otherwise, there is a problem in India also. That problem exists. But is it a macro problem? Answer is no. So that is a different type of problem. You have to pull more number of people to become middle class. That is a challenge in India. But US has a macro problem. They don't have a problem that there is a total addressable market. Almost everyone can afford everything, but they have a macro problem.
Very well put. To sort of summarize, you're saying US always had the fiscal deficit and current account deficit issues. The tariff was slightly just exposed it to the world. And obviously now with the recent downgrading by Moody's, it's more prominent. India, on the other hand, seems extremely positive on the macro side. It needs to trickle down to the micro factors, such that the addressable market of every category increases substantially. Vaibhav, anything that you may want to add from a macro perspective, specifically India, even if there is any lens on the global macro, would love for you to highlight some of the factors.
So very interesting phenomena is playing out. So a lot of liquidity is there in the system, but large part of this liquidity is going into asset classes, and which is leading to some sort of asset inflation. Corporates are not borrowing money. If you look at the corporate leverage is very low, which means there is no offtake from the corporates for private capex. On the other hand, personal loans are growing, and a lot of that money is moving into asset classes, and which is leading to some sort of valuation excess, which for me is potentially a risk for Indian markets. If you look at Indian markets and US markets, two of the world's most expensive markets, on one hand, India has the best macro in the world, and US possibly has the worst macro in the world. But India and US both continue to be the most expensive markets.
Got it. Weber, you brought in an interesting perspective about valuation excesses, and we as investors generally understand risks as a standalone risk, which is usually volatility. Would you want to sort of highlight more around what sort of risks do exist in the shorter term, and how should investors think about returns? Should they be looking at more as a longer term goals? And from a guidance perspective, what would you offer to stay us aligned with our investment horizons?
See, the biggest issue with the construction of portfolio is there is high degree of recency bias. So if you were to divide the risk of investing in two parts, one is asset class specific risk and second is behavioral risk. So behavioral risk is getting influenced by the recent performance of all the asset classes. So we've seen over last 5 to 7 years, many investors have invested a lot of money in equity and they have not seen negative returns for a prolonged period of time. So, which has created this impression that equity will always give positive returns regardless of how short or long your investment horizon is. And second, nobody's experienced a large drawdown or a long period of no returns. So these are the two behavioral risks which are there. Besides that, obviously you have asset class specific risk, which extends beyond volatility. Investors, each individual investor will have specific requirements, which would be their own specific liquidity requirement, income requirements, their own time horizon, their own uh, risk preference, and return expectation. All of these should be taken into consideration while designing the portfolio. And that's how I think investors should align their long-term objective with short-term market movement because different asset classes behave differently across different time horizons. So that for me is an important consideration when people are constructing portfolio for long term.
And I'll come to you, Naren sir. You obviously always been an ambassador for asset allocation, especially in such times. Weber, you did mention that there is some correlation between different asset classes at different point in time. Would you want to sort of dive further into that to give a little bit of more perspective around it? My question is whether there is any correlation between different asset classes such that, from an investor's lens, they can construct a diversified mix that helps them improve risk adjusted returns.
So we have been seeing it play out for last 6 months. Gold has delivered tremendous returns. On the other hand, equity has suffered. All the investors who invested in US dollar assets are sitting on negative returns, whereas non-dollar assets have done really well. So mixing different asset classes obviously reduces your risk and also stabilizes your returns. It has been a well-established concept in portfolio construction that mixing different asset classes with low correlation to negative correlation will result into slightly superior returns with much lower risk. So if you look at this data, every year you'll see different asset class doing better, and which means that over a long period of time, instead of sticking to one asset class, if you have been able to diversify across asset classes, your returns would have been much better.
Got it. Before we deep dive into forward-looking views on each asset class in the market, Naren sir, would love to hear from you on your thoughts around asset allocation.
We've been always exposing asset allocation over the years, but today is a very interesting period. 2 years back, we popularized multi-asset and said you have to find a way to invest in gold and silver. But today we find it funny. Gold and silver has done too well. Equity has done too well. Debt is at bottom interest rate. So no, where do we go? Real estate in all parts of India, like Gurgaon trades at some ridiculous price. Goregaon trades at ridiculous price. No, where do we go? So yesterday in 18 now, people asked me a question. I said, there's no cheap asset class left in India. So what do? We don't. So, we tell people practice asset allocation, and within that each asset class, identify the cheaper areas. So that's what you have to do, because there is no cheap asset class in India today. So, I mean, there was a time when people used to say when all asset classes are high, gold will be cheap. Now think about it today. Where do you go to gold? We can't go to gold. 2 years back, we did that. That's over now. Today, can you think that gold is the best performing asset class? So where do we go? So this is the challenge we are facing at this point of time. So, we tell people, think of crude. Crude has done very badly. So why don't you look at crude? So in the multi-asset fund, we have bought crude now because that is allowed. So we've done things like that, but it's such a challenge at this point of time. So the biggest task is moderating investor return expectations. That is, I think, more important at this point of time. And that because most people think that they can make huge money. And second, to get people to understand there can be losses. These are two things that we try to tell people to do, but occasionally it backfires. Because if you tell something, it goes and backfires. So I tell people India is today like Malabar Hill real estate or Banjara Hill real estate or Poise Garden real estate. Because it never falls, but it may not give you good returns because, how much can Malabar Hill real estate can't become costlier than New York. So that's not possible. So this kind of situation we are in. So reduce investor expectation, make them alive to the possibility of loss because no one believes there can be losses in any asset class. This is what we are trying to do, people. But most of them say, here is this person who has seen 90s who thinks about all this, but we are in a new India. But that's what we have to do. But that's what we try to tell people.
No, sir, that's a very interesting analogy, Malabar Hills real estate with the Indian equity markets. But, moving on, obviously the audience here would love to have deeper insights on each asset classes. So we'll move to the next segment where I'll ask each of you about what is your view on each of these asset classes. And within these asset classes, you can perhaps pick a segment, a category that you find you continue to be bullish on. We'll start with equity and we'll start with you, Naren. Within equity overall as an asset class from a return expectation perspective and specific pockets of equity where you find value?
See, clearly we came to a conclusion that large cap was much better. But if you look at large cap in the last 6 months, it has done extremely well. Now, from here is large cap is definitely safer. But is large cap cheap at 25,000? We can have some debates. We thought banks was much better 6 months back. I did an event in October in Chennai where I said B stands for banking. That is the only sector. But banks have done very well. What do you do there? So I would still say that large cap is safer. Is large cap much better? I don't know, but large cap is safer. So that is one thing we can clearly say at this point of time rather than saying it is better. I would say large cap is safer. So that part of it, we would say safer stocks within large cap also exist. So that part of the segment is safer. So that is what we would tell people. So, that is how we look at it on this thing. Clearly, if you look at many of the small caps, they are not safe. They may be higher return stories, but they are not safe. That is how we look at it at this point of time. And, SME IPO and all, no one talks so much about SME IPO. Maybe that thing has gone bust. And I would say, the biggest areas of risk is these unlisted. I think people don't understand the risk of unlisted. In early 90s, many of the unlisted companies which got traded in 94, 95 never got listed. So I would say, when people in one segment trade unlisted, they don't realize some unlisted companies will not get listed and you lose 100%. So I would say the most unsafe segment is unlisted. The most safe segment is the safer stocks in the large caps. That is very clear at this point of time. But nothing is, cheap. The cheaper segments are becoming costlier by the day.
Right. Vaibhav, your views on equity?
No, 100% aligned with what Naren said. Large cap, and we've been talking about large cap and getting a lot of backlash on reducing allocation to mid and small cap also. But it's little bit like 2007 of Indian markets, where we wanted to take a precautionary measure and reduce risk in the portfolio, but mid and small caps kept going up. And this can continue to happen for some time. But eventually, my sense is that rationalization will prevail in the market, and safer part of the market is where we will put our money in, even at the cost of short-term underperformance in the portfolio.
Fair.
Our view is that without US equity market correcting, I don't think Indian equity market can correct, because India is better macro. You need to see US equity market correcting more. Otherwise, it's impossible, because that is the situation we are in today. That is how we look at it. So, we'll have to watch the US equity market for directions on what will happen to India.
But on that note, of further question, given that you did mention that US macro seem relatively weaker and Indian macro seem stronger, the domestic flows, as you mentioned, continue to remain steady. And FIs have now looked at other emerging markets besides US because of the situations that prevail there. What could sort of stop this liquidity coming in? Because domestic remains steady, FIs are looking at India. That could be one of the U-turns on the market, right? Do we see any factors that can lead to that?
What we try to do at ICICI is see what can bring down Indian market. I think big fall in US market will lead to outflow even in emerging markets. So I think, then you can have outflow in Indian equity also from FII. So I think there has to be a meaningful, decent fall in US markets. That is the way I think this whole thing can play out. Otherwise, I don't think it's easy. I don't think Malabar real estate can go down.
Right. Moving on to the next part of the asset class, fixed income. Weber, I'll start with you. Any view on fixed income?
I think we are at the fag end of rate cuts now. 10-year GSEC, I don't think can substantially go below current levels, is what my view would be.
So from a duration perspective, you seem we are
Yeah.
fairly covered in the yields today.
Absolutely. But that doesn't mean, and sometimes we misinterpret fixed income by saying that if rates are low, why should we invest in fixed income? But it does give a cushion to your portfolio with predictable returns and no downside. So we should not forget the utility of fixed income in the portfolio.
Fair. Naren, your view?
See, actually, we used to recommend, the only area we used to recommend fixed income, but now yields have fallen. Then we started recommending, where I'm not involved, these performing credit area. Now, I feel that there are so many performing credit funds that they will bring down the yields. So now what we did, again, I'm not involved in it, we started recommending office yield. Because, India what has happened globally is that work from home is much more prevalent in other parts of the world. Due to that, offices have fallen, office prices have fallen in all parts of the world. Due to that, those funds have been forced to sell even in India. So what happens is that is an area which I think if you compare office space in many parts, the office space is cheaper than residential, and office yields are higher than residential. So I think that is a more interesting space at this point of time than other. But it is because it is the most attractive space within all these spaces. Because you're going to have 30 performing credit funds in India, all of them will drive the yields down is my biggest worry at this point of time. Because there is, as it is, no credit growth, as Vaibhav pointed out. So all of us will drive down that rate to such a level that you will find again there's a problem there. That's how we are seeing. Whereas today you don't have 30 office funds in India today. That is the advantage.
Right. And obviously, products like REITs exist, and we hopefully see more listings that would help. So, for the benefit of the audience, fixed income essentially means the debt part of the portfolio, where you would end up either locking your yields or get assured returns over time, barring, of course, the credit risks that exist. Moving on to the third asset class on the slide here, global equities. You've been very vocal about your views on US equities. Generally, any market apart from India that you like, any view on Chinese markets?
If you know a way to invest, I think I would certainly invest in global equities at this point of time. There are many areas in global markets where I personally invested through feeder funds, but many of those feeder funds which I invested are closed for subscription. And I would say that it is certainly an area to consider. It requires handholding. No investor can invest on their own. It requires handholding, and I believe that there is a clear requirement to invest at this point of time because global stocks are so much cheaper. Leave aside US and India, I think Vaibhav correctly pointed out these are the two costly markets. These two markets, all other markets in the world are very cheap. So I believe that there is a case to increase allocation there. How to do it, I don't know today. In the mutual fund, there is no possibility, I think, right now. Till that $7 billion limit is increased, there is no possibility. All the funds that we have, they're all closed for subscription right now.
Right.
So I would say if you have to think how to do it, but I would certainly take a case right now, tactically, that you should actually put some money there. Out of the equity bucket, you should put some money there. Don't treat it as don't treat it as debt or something like that, but out of equity. And it is not trading at Malabar Hill valuation. It is trading at what valuation I don't know, but many of the stocks are reasonably attractive. You'll be surprised to know that Indian market caps are so high today in many of the sectors that you can get reasonably attractive opportunities. And I would say this is the time to tactically have some allocation. Problem is, don't ask me vehicle, I don't even.
Vaibhav, your views?
On a similar view, we don't know what vehicles, so that's the challenge how to invest. But certainly, part of the portfolio should get invested in global equity.
Before we move to the next segment, I would like to remind the audience that there is a Q&A box. You can start posting your questions. We will try and address the questions once we are done with the first part of the session, which will be after the next question. So look forward to more questions from your side. Moving on to the next part. This is something that we gathered the audience would want to know. While we understand that short-term risk prevail, long-term risk prevail, uh, different asset classes put in together could provide a better risk-adjusted return to the investors. But should such asset allocation should be a point in time? Should it be static, dynamic? Also, should it be tailored to each individual preferences? Webo, I would start with you, and then we would go to Naren.
I covered this partly when I spoke about how investors should think about constructing portfolio. This reminds me of an African saying, when the drum beats change, you change the dance. So it's like that. So asset allocation definitely can't be static. You have to take into consideration your own financial situation, your individual goals, and plus market environment. One of the most ignored aspect of asset allocation is disregarding the relative valuations of asset classes. Naren said that all the asset classes are expensive today, so obviously that's a different debate, but it's an important consideration to take. When we construct portfolio, there is a tendency to look at historical average returns and extrapolate that, but that may not always be relevant in each market environment. So need to look at market environment and also look at your changing individual circumstances. Both of these are important consideration when you are choosing your asset allocation.
Naren, your views?
No, it should not be static. In fact, there was a time when we thought gold and silver was very good. There was a time when we thought that real estate is much worse than equity. So, there was a time when we thought that small and mid cap was very, very attractive. So it can't be static. The second aspect, if you ask me, and this is something only when Dezerv deals with that customer, you will know that customer. Is that customer capable of panicking in 2020 kind of environment? Is that customer actually capable of taking courageous decision in a 2020 kind of environment? This kind of thing, no, only you will know after dealing with that customer. Because years like 2020 present itself with superb opportunities to actually do a dynamic asset allocation, which appears risky, but gives huge opportunity to make money. But every investor is not capable of taking those courageous calls in a year like 2020. So I believe we believe strongly in dynamic asset allocation. And as you know, in that entire category, we have actually been the pioneers and focused on it over the years. But it requires the investor to be capable of doing it on their own. We have learned that investor is not always keen, but we as an AMC have been very, very keen. And we have found it extremely interesting and very rewarding for the investor. That you find a year like 2020, which will come once a decade, where you can increase your equity drastically, and the benefit will be seen years later. And there will be a year like 2017, which in that year we didn't have the assets, where you could actually again cut mid cap, small cap drastically, and you'll get the benefit if you bought in 2018, 19 mid caps, small caps. So this kind of opportunity will keep coming. But I believe if investor is going to do it on their own, they should have the right temperament to be able to buy in panic and sell in euphoria. Whether it is done by them comfortably or not, only you can tell after years of dealing with that customer. If they are capable of doing it, that's why I think the PMS format that you have is possibly well suited, and you should definitely attempt it at least partially, because that gives you can definitely have the temperament to do it. So in a year like 2020, increase your allocation in equity. It will be blood on the street, but you'll have to increase your allocation in equity in 2020 in those kind of cases.
Great, very well elaborated. To summarize, essentially, asset allocation needs to be dynamic. It will differ from individual to individual depending on their goals, depending on their behavioral tendencies, and of course, the market context.
I think that's a great point that Naren made. Risk tolerance increases with the risk in the market, so which should be technical inverse of what it is today. Whenever markets go up, we end up investing too much money in equity markets. So, and whenever markets go down, we don't invest. So it should be inverse of how we react right now.
Great. Thank you so much, Naren and Vaibhav. This was very detailed guidance on the macro environment today, the reasons for the market rally, and the market behavior going forward, as well as obviously the elaboration on asset allocation and how everyone needs to look at that as part of their portfolio. We will now open the floor for questions. As always, we'll try and cover as many questions as possible, given the essence of time. We will please excuse us if we are not able to answer some of your questions. I'll start with the questions. Uh, Question is for somebody with fresh liquidity. How should we go on building fresh equity allocations? Should we wait for some valuation corrections, or should we start building positions right away? Naren, you want to take it up?
No, we believe that you invest partially in all asset classes. That's why we recommend hybrid funds and invest in them. Because at the end of the day, you can wait for corrections, but don't invest all your money in equity. That is the only request. The worst will be you start today and say, I'll invest all my money. That is the worst thing to do. So invest in hybrid funds or invest partially in equity. That is what we tell people, so that as the market goes down, you have the ability to buy more and more. This is the framework that we tell everyone to do. And of course, it depends on your age, your requirement, how long you can invest, your risk parameter. I've violated by not talking about all
Or actually, a corollary to that, somebody sitting with fresh capital, you've already covered that. Weber, somebody already having made the allocation, is it a right time to rebalance and move some portion from, let's say, equity bucket to a fixed income bucket, so on?
Rebalancing should be an integral part of portfolio management, and wherever you see over allocation should be corrected back to your stated objective or your originally decided allocation. There is a great time to relook at your portfolio, rebalance your portfolio, and brings some money back into fixed income or other asset classes from equity. And within equity also, I think if you are over allocated to risky segments of the market, Naren touched upon being in the safer parts of the market, and it is important that you move to safer parts of the market. Having said that, it is possible that the riskier part of the markets continue to go for some more time. I can think of two instances. Nikkei in 1987 was trading at 30-35 PE, and everyone thought that markets were expensive. By 89, it started trading at 65 PE.
that.
In 99 2000, when dot-com boom was there, market started trading at 100 multiple. So it may appear in short term that you've taken a wrong call, but honestly, precaution is important in market, and valuation is your only guiding light in this market.
Got it. Moving on within equity, can you share some light on mutual funds? At this point, are index funds a good option? Whether this is a classical debate.
I think both have a place in the portfolio, and I'm sure Naren would agree with that. I don't think you can have either or approach. Both would have a place in the portfolio. For different segments of the market, you'll have to take a different approach. For different market environment, you'll have to take a different approach. When markets are going to operate in a very narrow range, or if breadth of the market is narrow, then purely investing in the index may not work. Or if you are looking at mid and small cap where universe is very large, looking at pure index investing may not work because you are also running a risk of high tracking error. So I think horses for courses is the answer for different market environment, different segments of the market, and both of these strategies would have a place in the portfolio.
Naren, your views?
No, as an active fund manager, I'm a believer in active fund management uh, and the hybrid funds. So, if you ask me, but in what I find interesting is suddenly people start saying in the last 15 days, active funds have underperformed passive funds. We are not working for 15-day underperformance or outperformance. If we start getting measured and people start writing that, it's very tough. Our goal, in any fund is to outperform at least, what we have told I have told my colleagues is in market extremes, you have to underperform. If market goes nuts, on both sides, whether it is too cheap or too costly, you have to underperform because you have to be rational at market top and market bottom. In 2008, if you were extremely rational at the market bottom, you would have taken cash call. That would be the biggest disaster in town. So, at extremes, you have to actually underperform. And that's how you actually create alpha in the long run. So I think the time frame for measurement on any active fund has to be in the longer run and across cycles. And that is the goal that we have set for our fund managers. But when people start looking whether we have outperformed in April, whether we have outperformed in May, I think that's a wrong way. Over a long cycle, which includes a correction and a boom, if we have outperformed, I think we have done a good job as active fund managers. And that's the goal we have set for my colleagues and me.
Got it. Weber, the next question is for you. We've obviously heard Naren's view on this. Any specific thoughts on small and mid caps? Would you completely avoid, or you feel there are active fund managers who can actually do uh, a good job at picking some of the small mid cap stocks?
If you look at the entire universe, there's very small part of that universe where there is some attractiveness in the market. I don't want to paint it with the same brush, but obviously a very, very small part of mid and small cap is attractive. If you're looking at broader universe, then I'll be really uh, careful in investing in mid and small caps.
Got it. Next question for you, Naren. Any specific sectors that you feel currently show fair or undervaluation relative to historical averages, with a good potential to sort of outperform over the mid to long term?
You'll be surprised to know IT you think would have underperformed, would trade at bottom valuation due to various concerns. It is not. It trades at a premium to 2018-19 valuation. So that is the surprising thing, that you would want to think that many of the sectors should trade at a discount. The only sector in 2024 second half which was trading at a discount was financials, banks. So that's why everyone used to tell banks, if you heard. But even that, today, if you look at it with consistent rate cuts which are going to happen, it is not very clear that it is going to be easy to actually deliver very good returns for banks. So it's very tough. I wish there could be 3 to 4 sectors which were very cheap. Then you could actually buy them and then put it in your portfolio and not worry about it. In 2020, we had telecom, PSU, metals, and all these sectors were there, which we could just buy them and forget because they were so cheap at that point of time. But today, it is so tough to find sectors like that. Almost everything has got re-rated at this point of time. Well, there's so much money which has come in the last 5 years into the mutual fund, PMS, AIF industry, and then from EPFO and NPS, that no pocket has been left undiscovered. That is the real challenge at this point.
Got it. Weber, the next question, perhaps you can respond to. From a asset allocation perspective, you did mention that it needs to be dynamic and personalized. But would tax be an important consideration in deciding the allocation?
No, absolutely. And individual tax, your income requirement, your liquidity requirement, your time horizon, your return expectation, your ability to manage drawdowns in the market, drops in the interim drops in the market. All of these are important consideration. It's a it's a multi factor consideration when you are designing your asset allocation.
Got it. The next question is around precious metal. Weber, your view on gold, silver going forward?
I think it should be part of the portfolio, but don't invest just because it has done well in the portfolio. Keep it for long term. Keep it consistently as a certain percentage in the portfolio. There is no financial model which can explain the upside in some of these things. You are investing in these as a diversification tool, and that's the role they play in the portfolio.
Fair. Uh, Next question is a slightly generic one, which is around what should be the reasonable expectations from a 5 to 7 year perspective. You did mention across the course of the seminar that we need to tamper down investment return expectation. What should that number look like?
Actually, I don't like to give that number. What happens is I tell people, there are two people who have successfully predicted markets with certainty, in the very near term. That is Harshad and Ketan Parekh. The long run also, would we have predicted 12 years back that this kind of return will come from 2013 to 25? The whole world told me GDP growth and market is linked. See the return China gave till 2024. It was zero for 24 years or something like that. So, and look at the return Europe has given. I mean, the US has given from 2012 to 2024. When we launched the US fund in 2012, US had given 12 years of zero return. Do you know that? And we collected a princely 100 crores in that NFO. And because people said, what is this US? US, where will it deliver returns? So, frankly, Japan 1990 to 2024 returns for that 34 years was zero. So frankly, if you ask me, there have been phases where the markets have delivered superb returns. There have been periods where markets have delivered very bad returns. India itself between 94 and 2004, gave almost zero return. That's why I am one of the few people from that previous generation still active in mutual fund industry. Most of the others have gone away because people left and joined IT industry saying, what is this market? It never delivers returns. And then they went and joined the IT industry. So giving these ideas gives too much confidence. Then they say, what does fixed deposit give? It gives 6% minus tax rate. So I'll not invest in fixed deposit. Then they make their equity 100% equity. Then it becomes a bigger problem. That's why I tell people, don't give any clear answers to all such answers where actually no one knows. Don't, but I think it will be so difficult for Vaibhav and you to give the answer that I have given to your customer. That's why I stay in a mutual fund and do investment function. Because if you told your customer what I told you now, you will not get any money. You'll go to some other wealth manager. That is the problem. So luckily, I don't have a sales job. And luckily, unfortunately, you cannot give the answer that I have given to you, to your customers.
Got it. Any view on thematic funds?
No, I'm a believer in themes. In fact, I'm a believer in if you can switch from theme to theme. And frankly, we have one such fund. And we are not supposed to talk on any fund today. But I would say that that is the best. See, if you can move from one theme to another in a proper way, you can get best returns. Actually, your PMS can succeed in doing that. Because imagine you invested first in infra theme between 2004 to 8, then decided now I'm going to invest in consumption theme. Look at the kind of returns that you would have got, because end of the day, you identified the bottom of the theme, then you identified the top of the theme. There's a time when you identified technology as a theme, 2021 to 23, it worked. Then after that, move out of technology. I'm saying theoretically, but I'm just saying that thematic funds are very good. But thematic funds require entry, it requires exit. The day you say I'll be permanently in a theme fund, then you are not going to get good returns. Because the problem with every theme is there's an entry point, there's an exit point. That is why your kind of strategy is better equipped to handle theme funds than other people.
No, excellent point. And the other additional point is most of the people invest in themes when they are already popular, and which becomes a bit of an issue while investing in themes.
Exactly.
Next question is around IPOs. Obviously, last year we saw a record number of IPOs. A lot of liquidity got unlocked in the pre-IPO shares as well. Do we see one, of course, a selling pressure pre-IPO and some of given where market is, and then perhaps IPOs may sort of be deferred. Do we see that kind of a pressure? And any view on how many IPOs can sort of play out over the next 12 months? Vaibhav, your views here?
Sorry, I missed that question. Can you repeat it?
So the question is around IPOs, and given that there were record number of IPOs in the last year, how do you see the IPO market going forward? Plus the fact that a lot of pre-IPO opportunities, would you see a lot of supply coming in that people would want to exit, given that IPOs may be deferred?
So unlisted, Naren responded that you need to be mindful of what you are getting into. Some of these companies may not come out with an IPO, so that you have to be careful about. And I'm hopeful that some IPOs come and they come at a reasonable valuation so that we get more opportunities to invest money in some of these companies.
Naren, your views?
No, I think I was an investment banker between 1990 and 94. And one learning that we have is that you have to be very careful investing in IPOs. The seller knows much more than you on that IPO. So you have to be very careful. And if you are an IPO investor, if you're going to flip the IPO, there is no problem. But otherwise, you have to know much. You have to be very careful because end of the day, the seller knows the value of the company more than you. So, but I think in the next 24 to 36 months, what we have been told by investment bankers, it's not 12-month view, it's 24-month view. There are numerous IPOs which are all ready. we offered to the public. But I would say that it is not easy to make money in the long run in IPO investing unless you follow a strategy of investing, making money in them on listing, getting rid of them. You follow that as a strategy, and that is a strategy which I think has worked over the years. So once you stop making money, stop investing in IPOs. That is okay, and you do some limited work on them. Look at the investment bankers, look at who are the anchor holders, etc., and then take that decision.
The next question is for you, Vaibhav. Multi-asset dynamically allocates across equity, debt, gold. Uh, in a rising interest rate environment, how does fixed income allocation get adjusted? Of course, right now we are not in that situation. This is a hypothetical question. Just understanding how the strategy works in a rising interest rate scenario.
So what fund managers do is to reduce the duration of paper. So if interest rates are going to rise, you invest your money in shorter maturity paper, 6 month maturity paper, 1 year maturity paper, which are less sensitive to interest rate movements. So that's the way multi-asset fund fixed income part is managed.
Got it. And in the current scenario, while we've sort of elaborated further on asset allocation, what should an investor focus on while watching the fixed income part of his portfolio?
I think two, three things. Don't invest in poor credit because returns have fallen. There would be a tendency to chase returns and therefore you compromise on credit quality. Also, be mindful of not taking too much of reinvestment risk or liquidity risk. So, these are the three risks that I'll be mindful of when investing in fixed income.
Got it.
Most of the accidents in fixed income happen when interest rates are low. People compromise on credit quality and then end up suffering losses in the portfolio.
Got it. So mispricing would be one aspect that you would be wary of.
Absolutely.
Fair. Uh, any view on the NBFC and microfinance industry, given microfinance largely has been in bad shape with RBI and SEBI regulations on collections, but any view on those segments from a fixed income perspective? Vaibhav?
Naren, you want to take that because
No,
you.
I think no, we are historically been careful on microfinance, and that has worked for us both on equity and debt. We continue to be careful because that segment, as I mentioned, even on the macro side, see, we need to see that segment of people, their incomes improve, that they are able to repay their loans. So we'll continue to be careful. If it is part of a company where we are comfortable on the financials, we will take a call. But otherwise, we will continue to be careful in that.
Got it. A couple of questions before we wind up for the day. Generic macro question, Vaibhav. What emerging trends or macroeconomic factors that you are monitoring that could affect the portfolio? I know we've sort of covered it during the session. Anything specific that you would want to quickly elaborate on?
Resumption of corporate earning growth is the only factor that I'm looking at right now. And I think that's the most relevant factor besides everything that we spoke about.
Everything else will obviously feed into that. So,
I think maybe we didn't talk about how this entire tariff issue plays out. We have to think.
Yeah.
Maybe it's forgotten in the last 1 month or so, but it can suddenly rear up their heads again, and how it plays out because we don't know. It's kind of forgotten, but can come back.
got it. I think one last question. I think this is largely around inverse relationship that we've previously mentioned, apparently, about between property prices and equity. Post-COVID, of course, everything's at an all-time high. Uh, how do you think does it play out differently over the next few years?
Right now, it doesn't appear to be because right now I think both markets are seem to be linked. But I have a feeling that equity market today is more important than real estate market. Pre 2013, the view we used to have is real estate market is more important than equity market. Now the view we have is equity market is more important than the real estate market. So the if equity market, if it has a proper problem, I think real estate market cannot continue. And so I think we have to look at the equity market for directions on property market. That's how we look at it. So people recycle their profits from the equity market to the real estate market. And pre 2013, I think the key market used to be itself real estate.
Right.
But now we have created a very, very vibrant and successful equity market.
Actually, on the contrary, there is a positive correlation
Yes.
because in an year where equity markets go up, you will see number of property transactions going up. Last year, you would have seen all the apartments selling for 100 crores, 150 crores, 200 crores. Nothing but a function of wealth creation which happened in equity market getting channelized into real estate. So there is no negative correlation. There is no inverse relationship between the two. There is a positive and very evident relationship between the two. The wealth effect of equity translates into people buying real estate in a big way.
Got it. Uh, no, once again, thank you, Naren. Thank you, Weber, for an incredibly valuable conversation. It's clear that asset allocation is not just a defensive tool, but a strategic one for the longer term. To our audience, thank you so much for joining us. If you'd like us to help assessing your current or fresh allocation, please reach out to your relationship manager. Stay disciplined, stay diversified, and see you all next time. Thanks, Naren. Thanks, Weber.
Thanks a lot.